Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to J.P.Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. This week on the podcast, I shall be speaking to Richard Pindar, who is the CEO of the investment management company that manages Literacy Capital, ticker Book. Interesting, small UK-focused private equity business that has had a very successful career on the stock market since it was listed a few years ago. And also I'll be looking back at the first quarter performance of the investment trust sector with Ewan Lovett-Turner, Head of Investment Trust Research at Deutsche Numis, talking about which sectors have done well and how the investment trust universe is looking as we head into the second quarter of the year. In the markets this week, we had one of those important regular monthly set of economic data from the US, in this case the non-farm payrolls, a measure of employment in the US economy, which came in stronger than the market was expecting, another indication that the US economy remains very resilient, and that was enough to help send bond yields up over the course of the week, quite significantly at the longer end of the maturity spectrum, and also cast a bit of a dampener over the performance of equity markets. This too against a background of rising oil prices, which touched $86 in the futures market, and also strong performances from both copper, which is up 6%, and gold, which was up another percentage point or so to $2,350, give or take. All of this, of course, may suggest that interest rate cuts aren't going to be coming quite as quickly or in such quick succession as the optimists have been hoping at the start of the year. In terms of the indices, though, it was a mixed performance. We saw China, yet again, performing quite well this week, up more than 1%. The Indian market continues to soar away, but for most developed markets, it was a less positive week. The S&P 500 finished down 2%, despite a rally on Friday following the publication of those payroll figures. It had fallen quite sharply the day before in anticipation of them. Nasdaq down around 2.1%, and the Japanese market, the Nikkei, was down around 1%. The FTSE All-Share was down around 0.5%. But the investment trust index, gratifyingly, recorded a small gain, up around 0.2% over the last 5 trading days. But losers outnumbered gainers by a small margin. Among those moving up, notably, we saw some significant gains on the back of news announcements from Hypnosis Songs, was up around 10% over the last 5 trading days, following the latest valuation from its new independent valuers. We also saw gains from BlackRock World Mining among some of the bigger issues, up 4.9%. The Chinese trusts did well, and private equity trusts on the whole were positive this week. On the negative side, we found a number of commercial property trusts, not all of them, but a number of commercial property trusts selling off, led by Aberdeen Property Income, following the decision by a small proportion of its shareholders to block the proposed takeover by Custodian Property Income. That one was down 10%. Other commercial property trusts were down a little less than that. TR Property, which owns a wide range of commercial property trusts across Europe, was down around 4%. And there were also declines for some of the tech stocks as well, including Manchester and London down 3%, and Scottish Mortgage was down around 3% again this week. Biotech and some smaller companies were also not in demand, selling off by 1% or 2%. Turning to results, there will continue to be a steady stream of annual results for the calendar year 2023 coming in. Best performance of those announcing this week was Nippon Active Value, ticker NAVF, the acquisitive Japanese activist trust, which was reported NAV total return of 23%, well ahead of its benchmark. Temple Bar, the UK Equity Income Trust, continuing its strong run. That reported a 12% NAV total return last year. Also good performance from Invesco Bond Income Plus, ticker BIPS, and Pantheon Infrastructure, which reported a 10% NAV total return. Also positive returns from Dunedin Income and Growth and CT Private Equity, though those are both slightly smaller gains for the year. Those not doing quite so well, or notably Baillie Gifford's Chinese Trust, Baillie Gifford China Growth, That reported a shocking NAV total return decline of 40%, which was some 10% or so worse than the Chinese index last year. And also small negative NAV total returns over the 12 months from Merchants Trust, the UK Equity Income Trust, from North American Income Trust, and from Schiehallion, the Baillie Gifford Growth Capital Trust, which was down just a short 1% NAV total return over the course of the year. This week, for subscribers to the Moneymakers Circle, we don't have a profile this week because of the Easter holiday, but we do have profiles coming up of Chrysalis next week, the interesting growth capital trust, where the management team is about to leave Jupiter and launch its own independent boutique fund management business. And following that, there will be profiles also of STS Global Income and Growth and Artemis Alpha. This week's weekly email also includes a comprehensive list of all the announcements of results this week and all the other news items of note that have come out of the investment trust sector this week, including there were announcements from Downing Strategic Microcap about its proposed B share scheme, which has been voted down by shareholders. An interesting development from Third Point Investors about a tender offer, which has been triggered by its discount averaging more than 10% over the last 6 months. And news items also from Princess Private Equity, Literacy Capital, RTW Biotech Opportunities, Hydrogen One Capital Growth, and several others. Also news about management and board changes, plus some comments on some of the news items this week that I've made, and a further addition to our regular selection of data about investment trust performance, this time including a table of the trusts which have made, either been the biggest issuers over the last 30 days or the most significant trusts implementing buyback policies. This week, European Opportunities Trust heads that table. It's bought back more than 5% of its market cap in the course of the last month or so. While on the other side of the ledger, there's J.P.Morgan Global Growth and Income continues to issue more shares. In this case, it's also completed recently the takeover of another smaller J.P.Morgan investment trust. My thanks also to all of those listeners who have taken the trouble to write in and say how much they appreciate the podcast and indeed the subscriber options open to members of the Moneymakers Circle. It's always very gratifying to get those messages, and I hope that we can continue to provide the kind of independent service that is of some value to you if you are either professionally or personally interested in the investment trust sector. I had the opportunity earlier this week to have a conversation with Richard Pindar, who is the CEO of Book Asset Management, the management company that manages Literacy Capital, the investment trust that has a unique set of features around it. It's a private equity trust that also donates a percentage of its NAV every year to support literacy charities. Had a spectacular performance since it launched on the UK market, and has just recently produced its results and made some other announcements. So very topical time to talk to you, Richard. First of all, perhaps we could just kick off by reviewing briefly the annual results that came out for the period to the end of December last year, where you continue to make good progress, but not perhaps at the same pace as you had in the first couple of years. Would that be a fair summary?
I think that's a very fair summary, yeah. So NAV in the year was up reasonably respectable 19% in the calendar year. As you allude to, not quite as stellar as the 2 years before that, which were the periods that we also had since our listing, where it was in excess of 50% and in excess of 90% NAV growth in each calendar year. Slightly more positively, the shareholder return was just over 30% in the calendar year 2023. So the slightly wider discount that we had at the start of the year was effectively largely closed by the year end of 2023. So, the shareholder performance was the 10th best of all UK listed investment companies. And so, we're reasonably pleased with how the year went, particularly bearing in mind higher interest rates and lower growth and a technical recession towards the end of last year that was announced early this year. And there were some highlights in 2023 as well, with 2 reasonably substantial exits that we had, or transactions. So those involving Kernel and Button Up Box, which were both 2018 investments for us. And in both cases, we made approximately 10 times our money. And both transactions completed at approximately a 50% premium to carrying value. So those transactions both obviously helped to contribute to the NAV uplifts in the year. And we would like, obviously, to see improved market conditions, growth, etc., coming from some of our portfolio companies that will help to improve the prospects for NAV uplifts in 2024.
So, as you say, you've set yourself quite a high hurdle, as it were, in terms of past performance to keep up with that. But in terms of what's happening, you said, obviously, you made a good share price total return last year. The shares had gone to a discount at the end of, I think, 2022. How did you put that right? What did you do to bring that back to where it trades today, which is at a very small discount to NAV?
It's a good question because I guess it's relatively topical for the sector as a whole. I guess, if I'm honest, what did we do? We didn't really do anything too tangible. We did, in our communications to the market, consistently say if this discount persisted, and it never got substantial, it was never double digits, but it existed. And for sort of the early part that we were a listed fund, it didn't exist. So in terms of the discount, it was still substantially narrower than many private equity trusts on the market. But we did say, look, if this does persist, we will take action because we don't think that it's warranted. We are prepared to spend our capital to buy back shares. And I guess what we did do tangibly was to go out and communicate and tell more investors about what we do, why we're different, why the cost base being low is beneficial to shareholders, why the model we've got ought to contribute to outperformance over the medium and long term. And I think that communication to shareholders has seen the share price rise more substantially than NAV, which has meant the discount has largely eradicated at this point in time. I mean, again, it goes back to what I think PE trusts should be doing. I think there are many PE trusts that on the discounts they're trading at should be buying back more aggressively. But again, given the returns we have made on some of our investments, a kind of single-digit percentage discount, in our view, isn't sufficient if it's temporary and short-term to buy back shares or use our capital to buy back shares, given the upside we think we can generate by completing new investments. So it's something always front of mind, something we consider and discuss. Thus far, we've not needed to use our own capital to buy back shares. It's more around, I think, careful communication to the market, really, to say that, look, trying to provide confidence that, almost a bit of a floor to the share price, really, or a maximum discount. And I think the market's responded reasonably intelligently thus far.
So in other words, they give credence, they give you credibility. That the market seems to have given you the view that when you say that, you mean it kind of thing, and you don't therefore necessarily need to do it because they believe in what you're saying and not yet doing. But looking forward, you're not ruling out the possibility of share buybacks at some point if that was necessary in your view, or if the discount got too wide to produce a better return than what you could get by investing more capital.
Correct. We've said consistently that we would do it if we felt it was the best use of our capital, definitely.
Before we move on and talk a little bit more about what's happening, I think in your latest announcement you said that you were thinking about proposing a B-share scheme for the return of capital. Can you explain what that would involve if you got there and what it's designed to achieve?
Yeah, of course. So as you say, we alluded to it in our most recent published results. There will be some more documents that follow as part of the kind of AGM process. The AGM will be held in May, so the documents will be published reasonably soon. But I guess what a B share scheme involves is effectively allows the trust, Literacy Capital, to return capital to investors in a tax efficient way. So many institutional holders will not be bothered as to how they receive capital back, whether it's dividends or whether it's treated as capital. But the B share scheme, rather than doing a tender offer or share buybacks, it allows us to effectively put cash back into the hands of shareholders. But that return of cash gets treated as a capital return. So effectively, mechanically, how it works is B shares are issued in proportion to the number of ordinary shares that ordinary shareholders own. And then those B shares that are issued for nil cost to shareholders are virtually instantaneously bought back by the company. So it's effectively an issue of share where the shareholder is given them and then they're immediately bought back and cancelled by Literacy Capital, and the shareholder receives cash for that. So the maximum amount that can be done is up to the share premium account of the company, which is a shade under £54 million, which is effectively the amount of capital that we originally raised when we were set up as a private vehicle. So that will be the maximum amount of capital that can be returned via the B share scheme. And so, we've consistently said again in recent fact sheets and the report that was published a couple of weeks ago, audited report, we do expect cash inflows. And obviously since the annual report was published, I think a couple of days ago, we announced the significant refinancing of a portfolio company, which will return in aggregate £20 million to the trust. That's almost 50% of the cash that we had returned to us in 2023. It's almost double the amount of cash that we had returned in the entirety of 2022. So just by virtue of time passing, greater maturity of our portfolio companies and assets that we've got, we are expecting to see, and we have seen, more cash being returned to the trust. And so it just provides additional flexibility for us to return capital in an efficient way to shareholders.
It will give you the opportunity, but you're not necessarily committing to doing that at this stage.
Correct. It's not an obligation. It's not something we're committing to, but it's just something that gives us more flexibility to use that as a mechanism should we feel it's needed.
As far as I'm aware, this is not something that a lot of other trusts have done. So how come that you've come up with this idea, and what is its advantage compared to other ways of returning money to shareholders?
I guess one of the reasons why many trusts have not done it is they tend to have much greater proportions of institutional investors. The institutional investors, from a tax perspective, are more ambivalent as to how the cash is returned. Equally, many trusts have not thought about doing it or have not needed to do it or wanted to do it because they don't seek to return large amounts of cash to investors. Ordinarily, when large amounts of cash are returned to investors, it's via a winding up of a trust. Obviously, we're not actually intending to wind up Literacy Capital. And so we need to have a slightly different mechanism to do it. You know, if you go into wind up mode, then you automatically get the ability to return capital in that way, but it's obviously relatively final for the trust. It's not intended to be a winding up in any way. We want the trust to continue to grow. And again, we're not wanting the trust to just exponentially grow and get larger for the sake of growth and charging more management fees. Again, you know, I'm CEO of the investment manager. The investment management fee is just 0.9% per annum relative to the shareholding that I've got. It's relatively de minimis. And so we want to do what's best for shareholders because that's financially the best thing for us as well as shareholders. And so I think that it goes back to the difference in our structure, our approach, our financial incentive, whereby I think many trusts prefer to hold on to assets because size equals greater financial benefits for the manager. Whereas I think we're much more focused around, well, we prefer to stay doing smaller deals. Again, we'll touch on the differences with other private equity participants in the types of deals that we look at. But we feel that the smaller end of the market, there tend to be more interesting opportunities. They tend to be less competitive. And rather than keeping hold of cash capital assets within the trust and then writing proportionately smaller and smaller checks that don't really move the dial for the trust, we'd prefer to return some cash if we felt we couldn't spend it in the same way and generate the same types of returns and just kind of keep that discipline and I guess pricing discipline and capital allocation discipline to make sure that our strategy doesn't change in the short to medium term.
So, as you say, this all kind of relates back to the structure, the way you set up the trust. And you would argue, I think, the best genuine way to align the interests of your shareholders and the managers, which is, some would say, I think, not always the case as far as some of the larger private equity businesses are concerned. On the other hand, you could say, well, the market cap of the trust at the moment is about 292 million, looking at my screen at the moment. Are you not concerned about the issue around liquidity, which has been a concern for a number of other trusts, people saying, you need 500 million at least to attract certain kinds of investors? What are you thinking of that? You obviously don't think that's as serious a problem for you. And of course, you might grow into 500 million market cap before too long. That, I'm sure, is what you're hoping.
Yeah, I think it's a completely fair point. And again, it's probably the primary reason why we've not bought back shares, because we don't want to aggravate that problem further. And again, if we are going to use the B share scheme to return cash to shareholders, we don't expect to do that to shrink the trust. It's effectively would be a way of distributing gains beyond where we are today. So our expectation is that we'll reduce the growth of the trust rather than to shrink the trust, because we do recognise in order to gain more institutional shareholders and support from those type of investors, they need to see a certain level of liquidity. And liquidity already in the trust is not substantial because around half of it is owned by the investment manager or members of the investment manager or directors of the trust who are not consistently trading the shares. So it's definitely a consideration. We don't want to make it worse. Equally, we will do what's best for the shareholders in the round. So yeah, it's one of several factors that we definitely do consider.
So you've navigated the last year in pretty good shape given the issues that were prevailing in the private equity industry. Perhaps you could explain to us what has been going on in the private equity market generally, first of all, and then we might talk about what's been happening in your particular neck of the woods, which is mainly UK-based businesses and where the UK market has been quite weak. So tell us, first of all, what is actually happening in the private equity market at the moment that you can observe and speak to? Obviously, a lot of private equity firms have still got a lot of cash. They've got a lot of investments that have not yet matured as quickly as they would have hoped because of the macro conditions. And there's been something of a buyer's strike because of investors not making new commitments because they haven't yet had money back from the earlier ones. How would you sum up what's been going on in the private? It has been a tough year for the industry overall, has it not?
It's an interesting question. I mean, it's quite a tough question, Jonathan, to answer, and that there's so many angles to attack that from. I guess my views in general would be, 2023 was a tough year. You look at the number of transactions that completed, it was very low. I think there's a variety of things that contributed to that. Obviously, higher interest rates was a massive problem and reduced equity returns for buyers. Obviously, to address that, buyers can offer lower prices. Sellers, quite understandably, were reluctant to take lower prices. So I don't know whether it's just on the buyer side. I would actually say it was probably sellers as well that were pulling processes. So lots of processes are taking longer, are being pulled by vendors because their expectations are not being met. There is still lots of capital dry powder out there, particularly in mid and large cap funds. That obviously is diminishing to an extent as new funds are struggling to match or exceed previous commitments that they received. I guess in the listed world, we saw some pretty extreme discounts last year at various points involving certain trusts that were completely, in my view, unjustified. And we have seen some of them narrow. They're still comfortably north of 30% in many cases, which against long-term averages is still pretty wide. I think all the evidence that we're seeing lately is that the valuations on transactions that are being realized are in line with or ahead of the carrying values. So I think at some point there will be more comfort that investors are willing to give or have, and more confidence that they have to buy more of these listed trusts. But equally, you do have this dynamic at the moment, which is much discussed and has been discussed for a long time. And again, people are hopeful might get resolved around cost disclosures, which affects many private trusts disproportionately badly. Again, it would be logical for that to be resolved in due course. But at the moment, you just have an excess supply of stock from sellers, or you've got a lack of buyers that are able or can, for whatever reason, buy the shares. And so again, I think it just means that whilst that's occurring, and whilst you can have the massive uplifts from trusts buying back their own stock at 35 or 40% discounts, I personally think they should be taking advantage of that if they have confidence in their portfolio. So, that's quite a variety of quick points that I've made, but there's all sorts of things I think going on in the private equity market at the moment. But I think in the long term, the mid and large cap funds generally will continue to do fine. I think there has been a bit of head in the sand around interest rates. You hear all sorts of stories of people making assumptions that interest rates are going to revert back to where they were. I don't think that is likely to happen. So I think there will have to be a slight smelling of the coffee and people waking up, both sellers and both buyers, to sort of meet somewhere in the middle so that more transactions can happen, because there will be more pressure from LPs saying, look, guys, we need the cash back because, you can't continue to sit on these assets forever. So I think we're starting to see some signs of that.
In terms of your own portfolio, you've said you've realized a significant portion, or all in one case, of two investments you've made. They were sold on to other institutions, presumably other private equity funds, so you sold them on. So how come you were able to achieve those good prices in these market conditions? As you say, very good returns from those two.
Well, both of the businesses were sold because the founders of those businesses wanted to go through a transaction. So again, we can be reasonably patient around, timing. We don't have to dictate to them when we want to sell. We can be a bit more flexible than that. Both businesses were trading extremely well, which obviously always helps going through a process to sell a business. The teams had done a great job. They'd built out the teams. They had really strong, comprehensive leadership teams that we'd helped to fill. And so when you've got investors that do need to invest, they want to invest, and they've got businesses with good leadership and good trading performance, then all things being well, you should get a reasonably good outcome. So, yeah, and there have been transactions that completed in 2023, but you did see these processes in many cases taking longer. You saw buyers wanting to do more due diligence, getting as much comfort as they possibly could. So it's not impossible to sell businesses. It's not just us that are selling them. It is more difficult than it's been. It's taking longer. But if you've got businesses doing good things, trading well, then kind of regardless of some of the broader picture, it should be possible to get some good outcomes.
Would it be the case that you would have been happy to stick with these businesses? You mentioned you're a long-term investor on the whole. Would you have been happy to stick with these businesses were it not, as you say, the desire of the founders presumably to take some money out of the business? Is that what it was?
Yeah, we would have been comfortable. We always go into our investments thinking and behaving as though we're going to own them forever. The reality is it's unlikely we're ever going to have a period or prolonged period of time where all of our management teams want to continue in the same vein or the businesses with the same shareholders for a long period of time. There are always going to be life events or points of change that mean that the businesses naturally should or could go through a transaction. And again, I guess we do have to manage. For instance, in 2023, we had £46 million of cash proceeds come back in, over 40 of that related to Kernel and Button-Up Box, the sales of those two assets. But we also did invest another £33 million. And so there is always a bit of plate spinning and capital return required in order for us to fund the new pipeline of investments. So yes, we're very happy holders of those businesses, but equally we do have to look at our assets and think which ones are performing well, which ones potentially have less upside than others, which ones are we happy to recycle capital and value from into new opportunities where potentially we might have the chance to make another 10 times our money on something newer and smaller. So there's a few considerations, but yeah, with both Kernel and Button-Up Box, we'd been with those businesses for 5 to 5.5 years, which is a reasonably long hold for a private equity type transaction. So it kind of suited all parties for us to recycle and I guess take the value that had been made there and put them into new opportunities.
So your hope or the presumption perhaps is that the kind of returns you can make from the new investments will be at least as good as you could have made by holding on to the ones that you already had as they continue to mature.
Yeah, exactly. I mean, the funds that we sold Kernel and Button-Up Box to are £1 billion plus funds. Their return expectations are different to ours. We're investing at the outset some relatively small businesses. The prices we're paying on entry to these businesses just by virtue of there's a lot less competition at our end of the market than more established businesses. There should be the ability to make better returns than what large cap funds can make because there's just less competition, there's less sophistication, the processes are less intermediated. So yeah, exactly right.
So you still run a very concentrated portfolio. I think you've got 17 names or something like that, of which a significant proportion of your investment is concentrated in just a few handful of names. So that, I guess, in theory, is a source of higher risk. But is that ever going to change? Are you going to change the sort of concentration if you do continue to grow? Or are you always going to keep 15, 20 names as the target?
It's a good question. It's a key kind of thing that we talk about. So I guess in terms of the number of businesses, we currently have 18. I think 18 is a reasonably good number for us for the time being. Again, these businesses don't just kind of flourish and grow with us leaving them out to pasture. We do have to get involved. We do have to help them. And so there is a, I guess, finite number of businesses that we can work with well and make sure we're investing enough time and effort into trying to turn them into the best possible investments and businesses that we can. And as we've consistently alluded to, we are expecting there to be more inflows over the course of 2024. As a result of that, there are likely to be some sales. There are equally likely to be some new additions. So, I'm not expecting there to be significant change over the next 12 months in terms of the number of assets that we're holding. I guess the other part of your question is around concentration, is not just the number of businesses, but also the weighting at the top end. So, RCI is now around a third of the portfolio, or was at the end of 31st of December, the most recently reported numbers. Grace is about 16%. So the top two businesses are around half the portfolio. And I guess we kind of view that as a positive. And the reason that those are such two sort of large weightings is just due to the growth that both of those businesses have experienced. So, our total investment into those two businesses, RCI and Grace, was less than £5.5 million. The total carrying value of those two businesses at the end of December 2023 was almost £150 million. So you can see that from those two investments, we've made approximately 30 times our money. And I guess many private equity investors, if they've got carried interest, which they invariably do, they will seek to sell those businesses as soon as they've made a good return being anything more than 4, 5, 6 times money might be sufficient for them to start moving a business towards the exit lounge. But actually, we don't have that financial incentive. And so we've got little incentive to sell a business, what might be prematurely, just to put some cash into our own pockets. And I guess if you've seen 3i in action and what we're hoping and what we've seen with RCI and thus far with Grace too, I guess it's the power of compound interest, isn't it? That, Mr. Buffett has used. If we've got a really good business with a very strong management team, we'd obviously prefer to own it and benefit from the uplifts rather than selling it to somebody else for them to benefit from them. And you do often see within private equity, private equity fund selling it to another private equity fund and then promptly buying it back again 3 or 4 years later. But actually all they've really done is missed out on the upside that they could otherwise have benefited from and generated for themselves had they held the asset. So it's a slightly different way of approaching things. I guess we do view it as a plus because we're not allocating disproportionately large checks to these businesses. The high weighting towards these businesses is by virtue of their strong growth, which is obviously a good thing.
Indeed, if you can make it happen, of course, it's terrific. Mainly you're investing in UK-based businesses. The UK economy has been not a particularly good performer. UK stock market's not been a good performer at all in relative terms. So what do your investments tell you about what's been happening in the UK economy? Are you just happen to be in the right sectors, or you just happen to be in the right companies? Are there any kind of general points you can make? I know that at least one of your portfolio companies, for example, you mentioned, which I think is called TechPoint, that did suffer last year from the economic impact. So what can you tell us about what's happening in the UK economy and how that impacts on your investments?
Yeah, we obviously get very frequent trading information coming from all of our businesses across a variety of sectors. And it was pretty noticeable, I'd say, in the second half of last year that performance was not as robust and as strong as it had been in the earlier part of last year or in previous years. And as you rightly say, TechPoint was one which had an outstandingly strong 2022. And then that reversed, I would say, in 2023. There are some specific reasons for that relating to kind of China, Taiwan, logistics and supply chains, shipping, etc., going through the Suez, all having an impact in 2022, which meant customers of TechPoint wanted to effectively build up inventory levels, which we've seen unwind in 2023, which has obviously reduced revenue and profits. But it is interesting. Some of the businesses we've got that are performing well at the moment, you'd think, well, that seems counterintuitive. And equally, some of the businesses that you would naturally think should be performing better perhaps aren't. So it's been very varied in the second half of last year. But I would say that the primary reason for NAV growth in 23, particularly in the second half of 23 being weaker, was due to macroeconomic weakness across the UK. Just B2B businesses, I think, were really struggling. And to get sales growth out of some of the businesses was really tough. So, naturally that has a knock-on impact. We can't continue to kind of shoot the lights out if the UK market is not doing well. But equally, we've got to recognise, again, going back to the bandwidth point, we don't have the size of team or the networks ourselves. Often we have to be quite involved in some of our businesses in terms of helping them to strengthen their teams. Our network only extends to the UK. So rather than, I guess, getting a bit too big for our boots and thinking that we can do it in other countries, we'd kind of prefer to stay close to home. So that's the reason for the weighting and the kind of exposure we've got to UK businesses. And even if the market is weak, with taking sensible decisions, we can still have our businesses grow and create value. It just might not be as quick as we would like. And as long as you're conservatively structured from a leverage perspective, which our businesses are, then you obviously have the flexibility to ride out any of those kind of short-term blips. So, yeah, I'd say it was a fairly tough 23, but 2024 thus far looks slightly more positive.
So I was going to finish on that note, actually, Richard, by asking you, most recent announcement was, apart from realising that 20 million of cash you talked about, you invested in a company called Live Business, which I think specialises in organising entertainment for holiday companies and cruise ships and things like that. Now, you would think that would be a kind of business that would be very much dependent on how the consumer's doing and the economy generally. That sort of implies to me that you're not overly alarmed now about what the outlook for the UK economy is from here. Would that be a fair implication to draw?
Yeah, it's interesting in that you might think that consumer spending is weak or fragile and what might happen with people spending money on holidays. I guess, as I said before, it's actually some of the B2B businesses we found more challenging. And actually, despite the backdrop of cost of living crises, etc., the consumer businesses we've got are trading very, very strongly. And particularly people are focusing their disposable income on, I guess, having positive experiences with their families. I guess what Live does, as you say, provides entertainment on cruise or in holiday resorts or holiday parks. And many of these holiday parks or cruise operators are becoming more sophisticated in recognizing that alongside quality of food, quality of entertainment for holidaymakers is kind of paramount importance if you want to attract them in the first place and you want them to come back again the following summer or the following winter. And so they're becoming more professional rather than just having it managed at a local level at a hotel by a hotel manager or by a single cruise liner. They're now effectively centralizing this and having a more professional operation and professional design and thought going into some of the orchestration of these programs and performances. And Live is a business that's really benefited from it. You know, the two founders, absolutely lovely chaps. Both of them come from a performance background, very well networked into the West End, have access to the best choreographers, the best talent that would otherwise be working in Soho or Covent Garden, and are happy to go to work on these types of cruise ships or in these resorts. And it makes a huge difference to these businesses. It's a relatively small spend for them relative to the cost of operating a cruise ship, as you can imagine, and actually making sure that it's a fun experience for families, or if it's an older generation, you know, again, having appropriate programs and shows that are of interest to the people on board or in resort is hugely valuable to these customers of Live. So it's a really lovely business run by really lovely people that, you know, the customer feedback is off the scale in terms of the positivity. So yeah, it's one we're really excited about. And again, it fits the exact mold of what we've been doing since day one, really. So it's helping founders of a private business, helping them to scale it further, helping them do things at a slightly larger scale than they've done in the past. So yeah, we're excited about it.
Well, I guess as a metaphor for where we are in the UK economy, that's quite a good one, really. A lot of gloom and doom out there, but at least people are out there to make the most of enjoy what they can. So that was Richard Pindar, who is the CEO of Book Asset Management, which manages the interesting private equity vehicle Literacy Capital plc. As we've reached the end of the first quarter of the year, it looks like a good moment to talk to Ewan Lovett-Turner, the head of Investment Trust Research at Deutsche Numis. Been an interesting quarter, Ewan, in the sense that we've seen a bit of a backward step, I think it's fair to say, in some respects for the investment trust sector. The discounts have widened a little bit further, particularly in some of the alternatives, though the actual index itself, I think, was slightly ahead on the quarter. So how would you sum up what we've just been through in the first 3 months of the year?
Yeah, it's been an interesting quarter, and then it started with a bit of a shift around in sentiment from interest rates going to be shooting down to a bit more higher for longer and pushing out that interest rate expectation. And as you mentioned, the universe as a whole, if you include 3i, was up around 3% in share price terms. Excluding 3i was up about 1.1%. And you saw early part of the year, particularly a bit of discount widening from some who come in very tight at the year end. And overall, over Q1, you saw the universe, excluding 3i, move from around a 14 to a 16% discount. And largely that move was alternatives, X3i, going from around a 20 to a 23% discount, and equity investment trusts overall a 10 to 11.5%. So a small widening, certainly, but still remaining narrower than they were at the nadir in October 23. And equity markets still very much dominated by that tech trend. And perhaps the Magnificent Seven is no longer the Magnificent Seven, and there's a bit more talk about the Fab Four. So maybe that's, losing some momentum, but certainly the likes of Nvidia and Meta are very strong. We saw amongst the investment companies, Manchester and London being the top equity investment company, up at over 20%. That's got around 50% in Microsoft and Nvidia alone. So very concentrated, but interesting. The likes of Polar Capital Technology, Allianz Tech up around 15%, and J.P.Morgan American also performing strongly, up around 15% as well. Other funds with exposure to those sort of trends, the J.P.Morgan Global Growth Income, Martin Currie, Allianz Trust, all doing reasonably well. And Scottish Mortgage also putting in pretty decent performance, helped by announcing a £1 billion buyback over the next 2 years. So very substantial buyback And that's somewhat around Elliott, the activist investor, announcing around a 9% stake. Scottish Mortgage has hit the ground running with over £130 million worth of buybacks since the 15th of March, and the discount coming in to around 5%. So still corporate action driving things as well as asset class performance. Things like healthcare, Europe, Japan amongst the equity markets also reasonably strong.
What kind of message are you getting, therefore, behind what's lying behind these numbers in terms of talking to potential clients, talking to wealth managers and so on? Hopes that the investment trusts are going to have a significant rally haven't quite happened. They performed okay. But are you seeing any sign that this kind of buyer's strike is coming to an end?
The picture's still pretty mixed, and certainly the biggest buyers have been, over recent months, the value-orientated investors, both UK-based and particularly in the US. Saba Capital, I think we discussed before, and now Elliott coming on the register. So hopefully this is a bit of the kick that very experienced value players are coming into the market and spotting this value, and that hopefully is a catalyst for more retail investors who hopefully that cost of living crisis, the inflation pressures are starting to wane, and maybe there's a bit more money for investment at some point. But really the wealth manager community, it's been pretty tricky still to get them to buy into some of these areas, with cost disclosures being a big headache, and that's certainly in the news these days, and some stock-specific issues particularly continuing to weigh on sentiment, and the whole sector slightly being tarnished by the brush of a few bad apples.
Indeed. Well, we didn't talk in the previous segment about the ones that haven't done so well in this quarter. I mean, you mentioned that some of the alternatives have obviously seen discounts widen, and the renewables in particular have been very disappointing. There's the kind of disaster going on at the battery storage firms, or at least what appears to be a very bad story there, and the others all kind of trading down as well. What are your thoughts on that?
Yeah, some of the sort of more laggards in the equity area, I can touch on that briefly. Well, equity or sort of quasi-equity, it's more been sort of muted returns, but discount widening and falling out of favour. Things like Aberdeen Diversified, which enthusiasm around managed wind down fell away, and the likes of Rick Capital and Caledonia's muted returns in rising equity markets have seen them derate to quite wide levels. UK equity and particularly UK small caps remained out of favour, and China as well was pretty weak. But as you mentioned, Jonathan, definitely the attitude to interest rates and expectations there has impacted the infrastructure, including renewable energy. Higher for longer rates have weighed on sentiment, and the prospect or the actual sort of lower near-term power prices also impacting sentiment, despite pretty resilient NAVs coming in. Yes, sort of some declines within there, but certainly what you're seeing is strong earnings and cash flow generation and strong visibility on that earnings, which is leading to high dividend cover, which is pretty much being ignored by the market in the face of just viewpoints on how interest rates will affect that long-term discounted cash flow. And really the big disappointments have been a couple of those battery storage funds, as you mentioned, with a challenging revenue environment, particularly in the GB assets, and suspensions of dividend for Gresham House and Harmony, seeing the shares go down, 62 and 50% respectively in the quarter. So really quite badly impacted, and perhaps things that were sold more in the expectation or pitch of a bit of a steady, regular dividend. But in fact, that earnings stream is a lot more volatile and very different from more traditional infrastructure. Yeah, also struggling Digital 9, down around 25% as it continued to try and sell and ultimately agreed to sell one of its assets, but also the board warning that the value in a wind down scenario might not be what assets are held at. So definitely concerns there. The big hits are much more stock specific than perhaps some of the broad brush issues, and you've also seen that in the property space, with Life Sciences REIT down around 38%, Regional REIT down 37% in the quarter. Life Sciences REIT struggling to generate the earnings expected at launch and halving its dividend, and Regional REIT experiencing those issues in the regional property and office sector. So some stock-specific issues, but there's some brighter spots in the alternative space as well, which I can certainly talk to as well.
Well, mention a couple of those now then. Yeah, tell us where you see some of the brighter spots.
So some of the bright spots within alternatives have been certainly private equity and growth capital type assets. And some of the specialist debt funds have been benefiting from that high rate environment and exposure often to floating rate assets, which have seen yields increase as rates came up. Private equity, the leader really across the sector in the quarter was Seraphim Space, which was up 43%. Not quite going to the moon yet, but recovering from quite a low base. But I think that's got some really interesting assets. And just today, one of its largest holdings, iSight, announced a contract with NASA. And that's a company that provides near real-time imaging from its satellite array and is EBITDA positive. So some companies within that portfolio maturing and generating genuine revenue and earnings, which is interesting, and perhaps scope for more recovery there. That growth capital theme, funds like Schiehallion, the Baillie Gifford run fund investing in unquoteds, including things like SpaceX, was up 10.5%. Chrysalis investments up 6.8% as shareholders approved continuation, and the board has also put in place firm capital allocation plans, which is a real theme within that private equity sector. We also saw Aberdeen private equity up around 16%, partly due to buybacks and a capital allocation policy, while the performance of 3i, the figurehead of that sector, up 16%, and HG Capital just continues to deliver up over 8% as its portfolio of software as a service companies continues to generate high levels of recurring revenue streams. And you've seen the discount narrow to low single digits there, which, really the quality of that company setting it apart in rating terms. You've also had some strong performance from some of the more esoteric areas of the market. Georgia Capital up over 30% on strong performance, particularly from its listed stake in Bank of Georgia. And things like Third Point Investors, the hedge fund, which one announced a tender, but there's a bit of positivity around one of its holdings, R2 Semiconductors, making progress with a patent claim against Intel in Europe. And some of those specialist debt funds, the likes of Biopharma Credit, solving one of its problem childs, but investments and others like 24 Select Monthly Income doing quite well in that higher interest rate environment.
You mentioned the private equity sector. We obviously had the big impact of Pantheon's announcement last year. They were going to try and do a lot to reduce the discount. Do you think that some of these other trusts in the private equity space are getting religion, if you like, if I can put it that way? Do you actually think that what we've heard from the likes of Third Point and Princess are all part of a process of perhaps the private equity trusts looking at the way they manage their shareholder base with perhaps a bit more attention than they've done in the past?
Yeah, definitely. I think the great steps have been made in the listed private equity sector to focus on capital allocation. You've had a period where the level of realizations from portfolios has been relatively muted, so cash flow available to do that is not in all cases forthcoming, and you've got to take care of your ongoing commitments as well. But I think a real changed pressure from shareholders, which is good to see, to make sure boards, when these funds are trading, sometimes in high 30s, and during the course of the year, though, some of the funder funds getting out to 45, nearly 50% discounts. I think it is really important to focus on, should you be making new investments, or should you be using some of the proceeds from sales to return capital through buybacks or other means, which is immediately accretive to shareholders, and also I think sends a very strong message. And you've seen Pantheon, since the implementation of its capital allocation policy, traded around a 5% narrower discount than HarbourVest, global private equity, its closest peer. And I think that's really clear messaging that the board are on the side of shareholders. Whilst HarbourVest has actually returned a decent amount of capital, I think it's done it in a much more grudging way, and the board has made some statements that it doesn't really think buybacks work, which I think is sort of shooting itself in the foot, and therefore it's trading on a wider rating. Princess private equity has benefited. Well, I think a new chairman, Peter McKellar, who's also a director of 3i and the ex-manager of Standard Life, now Aberdeen Private Equity, has really come in and improved governance there and focused on shareholder returns. It's made a very clear commitment that when the discount is trading wider than 30%, it's going to return 75% of its free cash flow through buybacks. If that narrows to the 30 to 20% range, then it will return 50% of buybacks. And that fund already pays a dividend of 5% of NAV. And so there you can see as a shareholder that you're going to meaningfully share in that return of capital and benefit from that uplift when the discount is wide. And I think that's big improvements there in governance. And quite importantly, just the other day, one of its larger holdings, SRS Distribution, announced the sale to Home Depot. That in itself will generate cash, but also led to a 1.6% uplift in NAV. So realization starting to happen. I'm feeling this across the private equity sector, that debt markets are unlocking to a degree. People are getting more comfortable about what the right valuation is. And so you're seeing some of these transactions start to happen. And that's really crucial in terms of proving valuations and getting people comfortable that those underlying NAVs are appropriately valued and continue. Historically, the stated NAVs of private equity and listed private equity have been very conservative, and you've seen uplifts on exits. And you can look back over many years and you can see that as being very consistent, partly because they value their assets based on a historic earnings and apply a liquidity discount. And then when you sell these assets, they're valued based on forward earnings and that liquidity discount unravels. So expect that to continue.
I actually noticed one of the interesting things is that some of the directors or the managers of Oakley Capital have been buying shares themselves, increasing their stake in the trust. Do you think that's, in a way, a sort of more credible message to give to investors than it is just to do share buybacks generally? Do you think that's something that other private equity trusts might consider?
Yes, and it varies the visibility you get on that. And Oakley Capital, members of the management team making some purchases, which is always good to see. The skin in the game, sometimes wary when it gets very extreme, but I think generally very healthy. And most of these managers will also be, certainly in private equity, heavily invested through the underlying fund. So sometimes you might not see it through the listed fund, you might see it in the underlying, or it might be in the underlying. But I think that's certainly a statement of intent. And you do see holdings across much of the sector. To a degree, sometimes the timing of that, you may or may not read too much into it because they're often restricted in terms of they know what's going on in the underlying portfolios and therefore can't buy listed shares. But say when you've had a NAV being announced and the like, that can often be a trigger that they're cleansed and available to purchase shares. And Oakley Capital recently had its results out and the NAV was already known for 2023. It was up 4%, a little bit more muted than, say, we saw in 2022 when it was up 24%, but still a pretty solid result in a period when people remain negative on the sector. And really key here is the organic growth from the underlying portfolio. Oakley Capital generated around 14% organic EBITDA growth. Lots of the funds quote a sort of gross growth figure, which is often a bit higher. But there you're seeing its portfolio of things like education assets perform quite well, and a number of its assets like North Sales, which struggled a bit during COVID, is recovering. So I think that's an interesting fund that focuses on entrepreneur-led businesses and has a great network there. Oakley have highlighted that the portfolio is becoming a bit ripe for realizations. Its long-term average holding period is just over 4 years, and the current portfolio is just over 3 years. So you're starting to get to that point where you'd expect a number of realizations. And there's been press reports about Ocean Technologies, around 4% of the NAV, that there's a sale process going on there, as well as Idealista, the Southern European property portal, which is just over 5%.
We should perhaps quickly mention Scottish Mortgage Trust. I should say that Deutsche Numis is one of the brokers to Scottish Mortgage, and we've had that mega buyback announcement, as you said, and the discount has come in, and that's a sort of flagship, if you like, for the investment trust sector. They seem to have got religion, certainly after last year, ructions and the board and everything else, and barely give it as a house. Many of its trusts are recovering a little bit, though the Chinese trust had a really tough year last year. What do you think the outlook for Scottish mortgages from here? They too have got some realizations potentially might be coming up.
Yeah, I think it's an exciting and differentiated portfolio in Scottish Mortgage. And we both mentioned the £1 billion buyback over the next 2 years. I think probably not unrelated that Elliott are there and they've mentioned they're supportive of that buyback. The activist investor has managed to build a stake over time that's just over 5%. So that has seen the discount narrow from around 15% in mid-March to 5-ish now. So you've had a substantial benefit. And as well as the signal on doing buybacks and the accretion that will bring and liquidity, I think it's a signal from the board and manager that they're comfortable with the outlook for the portfolio, particularly that unquoted portion of the portfolio, that they don't expect it to require lots of further investment. If you look back a couple of years, that was the worry for people. And now I think you've got the prospects of a number of companies there that have voiced potential IPOs or liquidity events. Things like SpaceX has muted Starlink spinning out and that now being profitable. So big progress being made in these businesses. Northvolt's another one, the battery manufacturer in Europe, which has made noises. And so I think that momentum in the portfolio, it maybe only takes one or two events within that private portfolio and you'll get a bit of a proving of valuations, hopefully the increase in liquidity, which would reduce the percentage in private holdings, and Scottish Mortgage has been active in paying down some of its shorter term debt or flexible debt. So it's got headroom there. So a number of the big pinch points of investor concern have been somewhat addressed in the last 12 to 18 months.
You're one of the first to highlight the need for consolidation in the sector. We have had some more consolidation going on, but in general terms, it's been much easier, I think, for trusts managed by the same manager to get together. We saw that with more recently with Henderson's and Aberdeen. Obviously, there have been a couple of cases. Do you think there's still more to come on that? We've also seen one or two that have not worked out. I'm thinking about in the property sector, custodian REIT's bid didn't go through, been rejected by shareholders. What are your thoughts overall on consolidation? Are we going to see more?
I think it will. It has been a strong and increasing trend over recent years, and I think it will continue to be strong as many of the investor base, for them, size and liquidity of the trust is very important. So they feel that they can have some ability to trade in and out in an institutional size. So that does force smaller funds to take a good look and see whether they're better as part of a larger vehicle. I think that's generally a healthy process. There can be some reasons to say small and beautiful in things like microcap and the like, and relatively niche products, but in more mainstream, I think that continues. It's not easy to achieve, and in more liquid equity orientated strategies, then the ability to return capital at close to NAV in a relatively short time period does make some mergers hard to achieve. But you have seen managers looking to take on mandates offering fee concessions, which does make it attractive. And particularly when you're putting two similar funds from the same manager together, then there's often a similarity of shareholder base and that gets support. It was interesting, you mentioned custodian property and Aberdeen property, that fall through. You did have another fund trying to come in and get in the action, which muddied the water. And ultimately, it appears that shareholders are preferring, and the board of Aberdeen Property Income are going to put forward proposals for a managed wind down. I think that's going to be maybe an interesting test to see what the environment is like for realising your assets and how easy it is to do that on a sensible time frame. So does that work out as a decent option for shareholders versus the potential to put two things together and make a larger, better vehicle? Time will tell on that, but we have seen a few trends in that as well. GCP, asset-backed income, not going for a merger with its sort of infrastructure sister fund and ultimately opting for a wind down. But these can take quite a long time period to execute, and you still have that valuation uncertainty. And if you're viewed as a forced seller by the market, then that can be a pretty unattractive place to be. So I do see benefits of merging trusts and think that will continue. But it's really important that the boards can seek to demonstrate to shareholders that there are advantages for them in terms of that earnings accretion and future prospects versus just winding down the vehicle.
I mean, the custodian property one was interesting in the sense that the market didn't really like that one from the beginning. It sort of marked the shares down quite heavily, didn't it? And yet the transaction required a 75% threshold to pass. And I think the chairman of Custodian Property pointed out that only 14% of the register on Aberdeen Property Income had actually voted against, but that was sufficient to block the change because there was just a lack of participation by shareholders in some of these votes, which I guess is slightly disturbing in a way and perhaps might need addressing across the sector as a whole as an issue.
Yeah, it's been a hot topic debated in over the last couple of years, really, of particularly direct retail engagement with voting of any sorts is typically pretty low. So in some cases, relatively small institutional investors can have a big impact on how votes go. It has become easier to a degree to vote. Some of the retail platforms have tried to make it easier, the mechanism of voting, but turnout still remains pretty low. It's disappointing to see that, particularly when there's very impactful events going on within a trust. But building that habit and building that engagement with direct retail shareholders about the importance of some of these votes is a tricky task when many individuals are probably pretty time poor and don't necessarily want to invest the time in reading huge deal documents to understand that. So certainly more work to be done in that area.
So finally, Ewan, looking ahead, when at the start of the year, there were a number of reasons put forward by people who follow the sector closely about things that could get better this year. We had the possibility of something being done about cost disclosure. We had the possibility of interest rates coming down. We had the possibility of more M&A activity as people spotted value at big discounts. But there's still an issue around liquidity. And obviously, as you said, a lack of buyers from the institutional wealth manager space. So any reason to change your opinion at the beginning of the year that there were possibly good times ahead for the investment trust sector?
I think it normally pays to be positive and optimistic. So, bears sound clever and optimists get rich is a widely heard expression. So I think you've got to try and maintain some of that positivity. There are definitely some of those headwinds you mentioned. There is activity going on, and we haven't before in my career heard investment companies mentioned so regularly in the House of Lords and fields of government. So that is positive that there's potentially some change on the cost disclosures, which are definitely harming demand for the sector. It definitely won't solve all issues overnight, but I continue to believe that the investment company sector offers a great opportunity for all investors, whether they be institutional or retail, to access a great crop of investment companies that can, serve their needs, and whether that's equity investment companies that within the investment company structure have a record of outperforming their open-ended sister funds, which prove that there's value in the structure, both through that ability to take a long-term approach, deliver consistent earnings and dividends, and the prudent use of gearing, and also exposure to different asset classes. And you do need to be careful about new and esoteric asset classes, and there have been a few areas where clearly people have got their fingers burned, but others will prove themselves through this period. And areas like listed private equity that have been around many of these funds for sort of 20 odd years, delivering consistent NAV and share price returns, I think really do have a place in investors' portfolios and offer a way that others generally would be hard to access through multi-year lock-up lives and high minimum investments, whilst you can get access to it through the London-listed investment company sector. I still think that has attractive value and will hopefully be borne out over time.
So that was Ewan Lovett-Turner, Head of Investment Trust Research at Deutsche Numis, talking about the sector so far this year and what might lie ahead.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.